Thank you for choosing to watch this video. For more stock market news updates so you can be an informed investor, please press the like button and subscribe. With that being said, let's dive straight into today's stories. Today, Starbucks workers plan to initiate one of their largest strikes, which strategically coincides with Red Cup Day. Red Cup Day is when Starbucks distributes holiday-themed reusable cups, which often result in blockbuster drink sales. The decision to strike on this particular day underscores the workers' efforts to leverage the company's dependence on high-traffic events to amplify their demands for better wages and working conditions. Despite the walkout, last year's Red Cup Day reportedly marked Starbucks' best single sales day ever. Starbucks' ability to weather such labor-related disruptions while maintaining strong consumer engagement reflects the resilience of its brand. However, the ongoing unionization efforts and the broader labor landscape within the company could pose challenges in the long term, affecting its reputation and relationships with both customers and employees. While over 360 of Starbucks' 9,000 corporate locations have unionized, none have secured a contract. The slow progress in achieving formal agreements between Starbucks and its unionized locations raises questions about the efficacy of collective bargaining in the modern corporate landscape. The outcomes of these negotiations will likely set a precedent for labor relations within the company and potentially influence broader discussions about workers' rights in the retail and service industries. In other news, U.S. retail sales experienced a slight dip of 0.1% last month, the first decrease in 7 months, according to government data. However, this was less than anticipated, with a significant portion attributed to reduced spending on gas. The nuanced nature of this decline, with specific factors like changes in consumer behavior and external economic influences, prompts a closer examination of the evolving retail landscape and its potential implications for the broader economy. Excluding auto and gasoline expenditures, sales actually increased by 0.1% from the previous month, indicating continued consumer activity as the holiday quarter commences. This resilience in non-automotive and non-gasoline retail spending highlights the adaptability of consumers in response to economic fluctuations. As retailers gear up for the crucial holiday season, understanding these shifting patterns in consumer behavior becomes essential for devising effective marketing and sales strategies. This strategy has been used by Target, which is a well-known retailer that has surpassed expectations, hitting the mark with earnings that exceeded investor forecasts. The retail giant's success is multifaceted, with its strategic approach to inventory management, online sales growth, and a focus on high-demand consumer goods playing pivotal roles. As Target continues to navigate the evolving landscape of retail, its ability to sustain this positive trajectory will be closely monitored by industry analysts and investors alike. Target's CEO, Brian Cornell, attributes shoppers' gratitude to the increased security measures that safeguard sought-after items, resulting in a third-quarter earnings report revealing a sales dip, but a 36% surge in profits, attributed to efficient inventory management and cost control. The delicate balance between enhancing security measures to curb theft and provide a positive shopping experience is a challenge faced by many retailers. Target's success in striking this balance offers insights into effective retail management strategies amid evolving consumer expectations and security concerns. In other news, Exxon, which has been traditionally associated with fossil fuels, is diversifying into non-oil investments by entering the lithium mining sector for electric vehicle batteries. The success of this venture will depend on Exxon's ability to navigate the complexities of the lithium market, secure sustainable mining practices, and contribute to the growing demand for electric vehicles. With plans to commence lithium mining in Arkansas by 2027, Exxon aims to become a leading global producer, targeting production levels of approximately 100,000 tons by 2030. This ambitious production goal places Exxon in direct competition with established players in the lithium market. The success of Exxon's foray into lithium mining will not only impact its own trajectory, but also contribute to the broader conversation about the role of traditional energy companies in the transition to a greener, more sustainable future. Despite its fossil fuel reputation, Exxon's scientists invented the lithium-ion battery in the 1970s, though production ceased shortly after. This historical footnote adds an intriguing layer to Exxon's current pivot toward lithium mining. Understanding the company's role in the development of battery technology provides context for its return to this sector and highlights the dynamic nature of the energy industry as it grapples with evolving consumer preferences and global sustainability goals. This move towards lithium mining follows Exxon's recent acquisition of oil producer Pioneer Natural Resources for $60 billion, signaling a surprising return to the fossil fuel industry amid broader industry trends. The juxtaposition of Exxon's investments in both traditional oil and cutting-edge lithium extraction underscores the complex strategic decisions faced by energy companies as they navigate a rapidly changing landscape. The International Energy Agency predicts a 40-fold increase in lithium usage from 2020 to 2040 as the world shifts from gas-powered vehicles to electric. This projection highlights the growing importance of lithium as a critical component in the production of batteries for electric vehicles. The implications of this surge in demand extend beyond the automotive industry, influencing global supply chains, geopolitical dynamics, and environmental sustainability efforts. The Biden administration echoes this enthusiasm for an electric future, announcing a $3.5 billion fund to support the manufacturing of lithium and other advanced batteries. This financial commitment underscores the government's recognition of the strategic importance of battery technology in achieving broader clean energy goals. The interplay between government initiatives and private sector investments will be crucial in shaping the trajectory of the electric vehicle market and its associated supply chains. However, some automakers, including GM and Ford, have scaled back ambitious EV production goals due to slower than expected consumer demand. This recalibration of production targets reflects the challenges faced by automakers in aligning their strategies with evolving consumer preferences and market dynamics. As the industry grapples with these adjustments, the pace of electric vehicle adoption and the overall success of the electric vehicle market will hinge on a delicate balance between technological innovation, infrastructure development, and consumer acceptance. Despite a slump in lithium prices from record highs in 2022, producers remain optimistic, viewing market fluctuations as mere road bumps. This resilience among lithium producers suggests a long-term confidence in the fundamental demand drivers for lithium, particularly in the context of electric vehicles and renewable energy storage. The ability of lithium producers to weather market volatility will be closely monitored, providing insights into the broader sustainability and economic viability of the lithium supply chain. You should also know that Disney's Marvel Studios, a juggernaut in the entertainment industry, faces a formidable foe: franchise fatigue. The Marvel Cinematic Universe registered its worst-ever opening weekend with The Marvels, generating $47 million domestically against a $250 million budget. This disappointing performance prompts a critical reassessment of the MCU's formula for success and the challenges posed by audience expectations and oversaturation. Disney CEO Bob Iger acknowledged a quantity over quality issue days before the release. This candid admission from the highest echelons of Disney leadership signals a recognition of the need for a strategic shift in the MCU's approach to storytelling and franchise development. As Disney navigates the complexities of managing one of the most successful film franchises in history, the company's ability to innovate and rejuvenate the MCU will be a focal point for industry analysts and fans alike. In response, Marvel has reduced its 2024 releases from 3 to 1. This strategic decision to scale back on movie releases reflects Marvel's commitment to quality over quantity. It also signifies a deliberate effort to address the concerns of franchise fatigue and ensure that each MCU installment resonates with audiences, maintaining the brand's cultural impact and box office success. Notable sequels like the upcoming Captain America have been delayed, while the budget for Blade, originally slated for 2023, has been constrained to $100 million. These adjustments in release schedules and budget allocations underscore the dynamic nature of franchise management within the film industry. Marvel's willingness to adapt to changing circumstances and prioritize creative integrity over rapid expansion is a testament to the studio's commitment to sustaining the long-term appeal of the MCU. The director of Marvel's 2023 success, Guardians of the Galaxy 3, now heads rival Warner Bros. DC Studios. This high-profile shift in creative leadership adds an intriguing layer to the competitive landscape between Marvel and DC. The success of Guardians of the Galaxy 3 and its impact on the Marvel brand, coupled with the director's role in shaping the future of DC's cinematic universe, adds an extra dimension to the ongoing narrative of creative talent mobility within the entertainment industry. Simultaneously, MCU star Jonathan Majors faces a high-profile trial on assault charges. This off-screen legal drama involving a prominent MCU actor brings real-world challenges to Marvel's carefully curated image. The outcome of this trial and its potential impact on Major's career and the broader MCU narrative will be closely watched, highlighting the complexities of managing the public personas of key talent in the age of social media and heightened public scrutiny. In technology stock news, we see that Microsoft has entered the AI chip market, unveiling its first AI chips, possibly signaling an attempt to compete with NVIDIA's established dominance. This strategic move by Microsoft underscores the increasing importance of artificial intelligence in shaping the future of technology. The dynamics of competition in the AI chip market, long dominated by NVIDIA, are evolving, with major players like Microsoft seeking to carve out their space in this critical sector. In the realm of space exploration, SpaceX has received FAA clearance for a second Starship flight, paving the way for an attempted launch tomorrow. This regulatory approval signals ongoing progress in SpaceX's ambitious goals for interplanetary travel and colonization. As the space industry continues to capture public imagination, the successful execution of Starship flights will be pivotal in determining SpaceX's role in the future of space exploration and commercial space travel. Additionally, Bloomberg reports that SpaceX is contemplating an IPO for its Starlink satellite business as early as next year. The prospect of a Starlink IPO adds a new dimension to SpaceX's financial strategy and the broader landscape of satellite-based internet services. The success of a potential IPO will depend on market conditions, investor appetite for space-related ventures, and the perceived viability of Starlink as a key player in the global connectivity market. Thank you for watching today's stock market news update. For more videos on the latest stock news, remember to press the like button and subscribe. With that being said, I wish you the best of luck and happy investing.